to this morning's class. As I told you, we are going to be looking at corporate taxation. Corporate taxation. So how do we tax corporate entities when it comes to they making gains, or they making profits, or they making incomes? So we are going to be looking at corporate taxation basically. Now, there are certain aspects of the corporate taxation that you might also be asked questions on. So place like taxation of shareholders. So if you are into a public entity or a company that sells shares for its members, or you're a shareholder in a company, how do they tax you, the individual? Because as an individual too, you must pay tax to the government. So that brings us to where we look at taxation of shareholders, and you must take it very critical because it's an examinable question. Your lecturer can ask you questions on taxation of shareholders. Now, a shareholder of a resident company, and you know a resident company already, is liable to tax, or is liable to a withholding tax of 8% on dividend earned during the year of assessment. So if a company is paying you dividend, they must take out 8% of that dividend as tax. Let me pick this call. All right. Yeah, please. Sorry for the delay. Let's continue. So as I was saying, anytime the company is going to pay you dividend, they withheld 8% from that. So example, if the company is going to pay you 1,000 Ghana cedis dividend, then it means that out of the 1,000 dividend that they are going to pay you, they must take out a tax of 80 Ghana cedis inside. So the 80,000 Ghana cedis that they will be paying to the government, then they will give you 920 Ghana cedis. So that is what it means. So when we say we are withholding tax, it means that the money we are supposed to pay you, we are taking tax inside and give to the government, with the notion that when we ask you to go and give it to the government, the likelihood of you giving it to the government is very low, or the likelihood of you declaring that particular income to the government is very low. So at the end of the day, the government mandates certain institutions to withhold tax from your income anytime they are paying you. Are you getting it? And this is one. So anytime a shareholder of a resident company is being paid dividend, we withheld tax of how much? 8% from it. Now, how then do we calculate dividend for a shareholder? Or how then do we then say when we are paying dividend to a shareholder, what are some of the things we must take into consideration? Now, one, a dividend paid by a non-resident company to a shareholder. So a gain made on disposal of the shares where a shareholder sells shares in a company. So now, these are some of the things on which they calculate the tax on. The dividend they are paying you, and then gains that you are making. So When we talk about gains, it means that you bought the shares at 10 Ghana cedis, and now the shares are being sold for how much? For 15 Ghana cedis. So you make a gain of 5 Ghana cedis. That is the capital gain. And we'll look at that in business finance, then you know. So for a resident company paying dividend to a resident person, there is a withholding tax of how much? 8%. But a dividend paid by a resident company to another resident company, the first one is a resident company to a resident person. So the company to you as an individual. But from the company to your company is a resident company to another company. So take note. So a dividend paid by a resident company to another resident company is not taxable. It's not taxable. So it means that if company A is paying dividend to company B, we don't tax it. But the company receiving the dividend must own directly or indirectly at least 25% of the voting right of the company paying the dividend. Now, what they mean here is that a company paying dividend to a company, there is no tax because the company will be paying tax on his income definitely when he's filing it. So a company paying to a company, all things being equal, there is no tax. But they will not tax you only if you own more than 25% of the voting right. So let's say MTN is paying dividend to Barclays. MTN will not hold tax from Barclays dividend only if Barclays owns more than 25% of MTN shares. But if Barclays own less than 25% of MTN shares, then MTN will consider Barclays as a person. And so therefore, Barclays will take out 8% of that dividend before giving it out to Barclays. That is basically how the taxation of shareholders is saying, or what you are supposed to be putting down. Now, a dividend paid to a shareholder by a company is deemed to be proportionally related to the interest in the company. What do they mean? When they say a dividend paid by a resident shareholder, uh, paid by a company to a shareholder, is considered to be proportionate to his interest in the company. What do we mean? We mean that if the shares you own in the company is 1%, it means that any dividend that we pay you is equivalent to the 1% you own. So if we declare dividend of 10,000, 1% of that dividend is for you. If you own shares of 2% and we declare dividend of 10,000, 2% of the 10,000 is for you. That is basically what that particular statement is saying. So taxation of shareholders, when you are asked question on it, you should be able to raise at least 4 points to buttress your case. If you have any other question, you ask me. So the key point there is that from a resident company to a shareholder, we withheld tax of 8%. If it is from a resident company to a resident company, then we withheld tax of 25% only if the receiving company is not. We withheld tax of 8% only if the receiving company is not holding up to 25% of the voting right. But when you own more than 25% of the voting right, you are exempted from the withholding tax. That is basically what taxation of shareholders mean. Now, the next thing you should also take note of is one, taxation of branch profits, or another area you should take note of under corporate taxation is taxation of branch profit. A company can have several branches. So if this company have several branches, how then do we also tax them? Because a company can be in Nigeria, like Guarantee Trust Bank. The head office is in Nigeria, but it have branches in Nigeria. It have branches in Ghana. The tax laws applicable in Ghana is different from the tax laws applicable in Nigeria. You have Standard somewhere, you have Barclays somewhere. The tax laws are applicable in different jurisdictions. So how then do we factor in those tax laws when it comes to taxation in the company? Now, there's a tax payable by a non-resident person which operates a permanent business establishment in Ghana. So when I take a Melcom, for example, Melcom is a non-resident person. The people who are applying their trades here in Ghana are all non-residents. So, but they are operating a permanent business here in Ghana as Melcom Group of Companies. They are operating a permanent business here as Melcom. They are operating a permanent business here as ShopRite, as Game, whatever. But all these people are non-resident person. So tax payable by them, I getting it? Tax payable by them as the business they operate here and they get income as they repatriated is 8%. So any money they generate here in Ghana, which they will be sending back to their mother home, they pay 8% on the gross amount, not the net amount. So everything they sell, after lessening the cost of sale, whatever they get as their gross profit, they pay 8% on the gross profit as tax to the government. So taxation of branch profits, as I'm saying, a non-resident person who operates its permanent business in a residence country or in another country is liable to pay 8% as tax on the gross amount to that country, or 8% on the repatriated gross profit as tax. And this tax shall be paid 30 days after the declaration of that profit. That is all about taxation of branch profit. So any branch that is supposed to repatriate profits. So when we are talking about repatriation from one country to another, so they are repatriating it from Ghana here to India, then it means that they must pay 8% of that money they are sending to India to the Ghana government before they can send that money to India. That is what it means. And such 8% must be paid 30 days after they declare it. So if they declare it here on 31st January, by 29th March, they should be able to declare that tax or pay that tax to the Ghana government. That is basically what taxation of branch profit is talking about. I get it. If you have any question, you ask me. If you don't have any question, I'll move on. Now, from taxation of branch profits, taxation of shareholders, we'll now look at the taxation of the company itself, or the taxation of the business entity itself. And tax is always paid on the net profit of a business. Take note, tax is always paid on the net profit of a business. But now, how do you then tax the net profit of a business if separate accountants use separate methods of recording? When we are going into financial accounting into deep, you get to a point where, or even not into deep, you already know that we have two methods of presentation in accounting. We have the accrual method, and then we have the cash accounting method. So the accrual method states that whether revenues have been earned or received, we must recognize revenue. Whether expenses have been paid or incurred, once they have been incurred or once the service for the expenses has been rendered, we must recognize it as expenses. That is the accrual method. So in a nutshell, the accrual method is saying that whether money come or money go, once the service has been rendered, recognize it as money is pending to come or money has come. That is why somebody can come and work for you before taking money. That is why you can pay somebody before getting the goods. That is accrual. But cash accounting is saying that if you don't pay the money, don't record. If you don't receive the money, don't record. So let's say these two accountants, one accountant has been trained to use accrual accounting. One accountant has also been trained to use cash accounting. You can see that in a nutshell, the accountant who is using accrual method will not understand if he goes and declare profit of 5,000. They are telling him to pay tax of 1,000 on it. You think, but the 5,000 that I have declared here doesn't mean that I've made that money. Most of them are yet to pay me, so I can't pay. The cash accounting too might be understating his profit because there are some that he has sold already, but he has not collected that money yet. So whatever profit he must be declaring might be in an understatement. Then in a nutshell, the same accountant or the accounting profession is saying that we must match revenue against expenses within the year. So you can see that somebody who might be using cash accounting must be understating big time. Then another thing is that, how come one accountant is using straight line method to depreciate his asset? Another accountant is using reducing balance to depreciate his asset. The taxman will be confused. Then the taxman realize that you the accountant, you say that you have business entity concept. You cannot meddle your private affairs with the business affairs. So therefore, the owner of the business is separated from its business. So then how come now the business is paying electricity bill for the owner? How come now the business is fueling the private car of the owner's wife? So the tax man will become confused and will be like, no, the same profession. You guys are doing different things here back and forth. So it means that the profit you are declaring, Crapo, is not the best. So now when you bring your financial statement, they will examine the financial statement. I get it. So they will go through one by one and see that things that you have placed inside are not in conformity or are in conformity with your own principles. And because they also want to satisfy their principles of taxation, okay, we have principles of taxation. Everybody is going to mention one. I've unmuted all of you. So Comfort, you mention one, canons of taxation or principles of taxation. Delphina, you also mention one. Mercy, you mention one. Nick, you mention one. Eunice, you mention one. Yes, I'm listening. Canons of taxation, Murefi. Principles of taxation, Murefi.
Remember the question again.
Principles of tax or the canons of taxation. Murefi. Equity, economical, convenience, Murefi. Wakai. So we have equity,
efficiency,
minimum, fairness. You know. So principles of taxation or canons of taxation, these are the two words they use to
taxation.
Please reframe the question again.
So when you are asked to list the principles of taxation or the canons of taxation, these are some of the things you must be saying. Now, one basic principle the taxman don't always want to compromise on is equity, equality, and fairness. He wants to be seen as fair as possible to all the taxpayers, so that no taxpayer will come and say that I'm being cheated in that order. I get in the scenario. So equity, equality, fairness is one principle of the taxman. Now, okay, because I'm recording the work, let me pause it